Good evening, students. So the topic for discussion today, so we are going to discuss two topics today basically. One is chapter 16, which is appeals and revision, and another is chapter 14, which is income tax authorities, the powers of income tax authority, the rights of the assessee and the department, as well as the section 138, which relates to basically the right to information. So majority of our time we would be discussing chapter 16, and towards the end we will briefly discuss chapter 14. And as you all know, the purpose of today's session is basically to revise the chapter 16 and 14 instead of having a detailed discussion. For a detailed discussion, we already have one session recorded on chapter 16. In fact, you have got two sessions, one on chapter 16 part A, which is appeals, and another on chapter 16 part B, that is relating to revision. So you have two detailed sessions of each of 3 hours on these two topics. So today, wherever you feel that you would want to discuss your queries, please feel free to interrupt in between, and wherever you want me to repeat any content, participate, ask questions, and just as you know that the purpose of today's session is only revision of what we have already learned. So we'll be taking up only those topics which are quite of importance, as well as which requires detailed discussion. The procedural provisions we may skip, or we may just read through without much debate. So feel free to participate in the discussion. So this is, the overview of the chapter, as you can see. So yesterday, the day before yesterday, we discussed the assessment procedure chapter, where we understood the filing of return of income. And once the return is filed, there is a summary assessment which is undertaken, which is another way it is called a system assessment, or the kind of 143.1 assessment, we call it, that is performed these days by the systems. And thereafter, the assessing officer carries out the scrutiny assessment of selected cases, and that scrutiny assessment is now conducted in a faceless manner. And in some cases, there are exceptions like transfer pricing cases or cases involving international tax. They are carried out in a non-faceless manner. And we also discussed section 144C, which is relating to dispute resolution panel. So now, taking the same kind of a topic broadly, litigation, a step ahead, what we are going to discuss today is basically the appeal mechanism and the revision proceedings under the Income Tax Act. So once the order is passed under the Income Tax Act by the officer who is lower in rank, typically we call him the assessing officer or your jurisdictional officer. If you are aggrieved by the order passed by the assessing officer, that is, you do not agree to the additions or the adjustments which either are made by the CPC or by TDS officer or by the assessing officer, whosoever is lower in rank, you have got an opportunity to represent your case before a higher authority, and we call it an appeal mechanism. So broadly, there are 4 levels of appeals. One is the appeal before Joint Commissioner of Appeal or the Commissioner of Income Tax Appeals. The second is the Appellate Tribunal. As you all know, it is called as Income Tax Appellate Tribunal. The third is High Court. And the final, that is Apex Court or the Supreme Court, as we call it. So these are the 4 different level of appellate jurisdictions which are provided under the Income Tax Act 1961. We also will be discussing the provisions relating to revision of the order passed under the Income Tax Act, which is section 263 and section 264. 263 is basically a revision by the Commissioner of Income Tax or the Chief Commissioner of Income Tax in relation to the orders which are prejudicial to the interest of revenue. And 264 is in relation to the orders which are prejudicial to the interest of assessee. So we'll be discussing in detail those sections. And then, yes, the monetary limits which are fixed for filing of appeal by the income tax authority. So when it comes to filing an appeal before a Commissioner of Income Tax appeal, it is always the assessee who files an appeal. Whereas in case of appeal before the authority, which is Income Tax Appellate Tribunal or High Court or Supreme Court, it is the department as well as the assessee who have got a right to approach any of these appellate forums. And therefore, to reduce the litigation, the CBDT has been authorized to fix the monetary limits for filing of appeal before these authorities. We'll also be discussing briefly the doctrine of partial merger and total merger. What is the implication of this doctrine and what does it really mean? Let us first start with appeals before the Joint Commissioner of Appeal or the Commissioner of Appeals. Now, this concept of Joint Commissioner of Appeal was introduced recently, whereas the concept of appeal before the Commissioner of Income Tax Appeal, it was already there for many years, in fact, the decades. So, why this section 246(1) and why appeal before the Joint Commissioner of Appeal? Why this two level of kind of authorities separately specified? One is section 246 and another is section 246 capital A. As I mentioned, department cannot approach the Joint Commissioner Appeal or the Commissioner Appeal. Like the assessing officer cannot file an appeal because he is then adjudicating officer at the first it's the first starting point of any assessment. So whatever order he is going to pass, and if the assessee is aggrieved by those orders or assessee wishes to contest the adjustment made by the officer, then only assessee files an appeal. But then why at the first level we have got two different authorities? So prior to 2024, the 246 capital A, which was an appeal before the Commissioner of Income Tax Appeals, was there. Lot of appeals were filed over a period of time, and it was seen that the first appellate authority, Commissioner of Income Tax Appellate or Commissioner of Income Tax Appeals, was flooded with a lot of appeal matters, but the disposal rate was quite low. And post introduction of the faceless assessment or the virtual assessment, the number of orders with the adverse kind of an adjustments significantly increased. So this, kind of flooded the Commissioner of Income Tax Appeal with a lot of matters. And the faceless scheme was also introduced for the Commissioner of Income Tax Appeal level. So due to the higher pendency, the concept of Joint Commissioner Appeal was very recently introduced by the government, and the section was accordingly, kind of introduced, wherein the jurisdiction to deal with the smaller matters generally vests with the Joint Commissioner Appeals, or it is basically bifurcated on the basis of who is passing the order. We will see it a little later, but the almost kind of orders which are available before both these authorities are similar. So let us, with this little bit of background, we try to understand the provisions and the mechanics of both these sections. Now, firstly, which are the orders against which you can file an appeal? Now, this is very important. In our earlier session also we discussed. You can't file an appeal against any action of the assessing officer. Anything that is adverse to you or anything you are aggrieved by, you can't simply approach the Commissioner of Income Tax Appeal under this section. It is only when the order which is passed is under a particular section which is specified in section 246 or 246 capital A, you can approach the first level appellate authority. What kind of orders are we covering here? The order being an intimation under 143(1), where the assessee objects to the making of adjustment or an order of assessment under 143.3, which is scrutiny assessment we discussed 2 days before, and section 154, which is basically your best judgment assessment in certain situation where there's a failure to cooperate, where assessee fails to furnish the information required, or whatever assessee fails to file responses, those situations which are given in those sections, assessing officer reserves the right to pass the order under 144. Now, against all these orders, you can file an appeal before the Joint Commissioner of Income Tax Appeal. Order of reassessment, section 147 is also covered. The order being an intimation under 200 capital A, where the deductor objects to making of adjustment. Again, this is relating to the TDS kind of proceedings, where there is any kind of failure to deduct or short deposit, short payment, all kinds of adjustments which are within the purview of 200 capital A, you can file an appeal. Likewise, if you have faced the T201 proceeding, which is again relating to TDS, 206C, which is relating to TCS, then you can approach the Joint Commissioner of Income Tax. An order being an intimation under 206CB, then penalty, any of the penalty which is imposed under the Income Tax Act, Chapter 21, you can approach the Joint Commissioner. 154 and 155, which is basically, in fact, in case there is any order in the nature of rectification of apparent mistake passed by the officer and you are aggrieved by that order, you can approach the Joint Commissioner. However, as you can see, no appeal can be filed before the Joint Commissioner if any of the above order is passed by or with the prior approval of the Income Tax Authority above the rank of Deputy Commissioner. So what they are saying is, if the order is passed by the Deputy Commissioner or above the rank of a Deputy Commissioner, then you cannot file the appeal under section 246. In that case, you have the option available that you can file an appeal before the Commissioner of Income Tax Appeal. Now, CIT appeal is higher in designation as compared to Joint Commissioner of Income Tax Appeal. So this is basically a threshold kind of a thing which is introduced in the law. Appeal pending before Commissioner Appeal in respect of appellable order may be transferred to Joint Commissioner. Now, as we discussed in the beginning, the primary purpose of introducing Joint Commissioner of Appeal kind of a designation and the procedure in the law is to reduce the pendency of appeal with the CIT appeal. So this section was specifically inserted wherein the powers have been vested to transfer the matters, like board is going to transfer the matters from the Commissioner Appeal to the Joint Commissioner of Income Tax Appeal based on the criteria and the appellable order thresholds that were given. Appeal pending before Joint Commissioner Appeal may be transferred to the Commissioner Appeal. Opportunity of being heard to be given before transferring the pending appeal. Now see, when you are going to file a fresh appeal, of course, the matter is directly going to go with the Joint Commissioner of Appeal. But when this session was introduced, there were already a lot of pending appeals with the CIT appeal. So in case the matter is being transferred from the pending appeals to the joint CIT appeal, this is a practical application of the session. In that case, there is a transfer, there is a change in the kind of appellate authority within the department. So you need to seek you need to provide an opportunity of being heard to the assessee before doing it. Then this is an I think a standard provision which we discussed in the earlier session also, where the government has been transforming the assessment and appellate mechanism so far as the income tax law is concerned. And initially they started with virtual assessment. It was a face-to-face but virtual assessment. You can see the officer, but then they moved to the faceless assessment. Now the same procedure is also introduced in the appeal mechanism, where when you file the appeal, you will not know that before whom the appeal is going to lie and who is the Commissioner of Income Tax Appeal or Joint Commissioner Appeal who is going to listen to your matter. So it is again going to be a dynamic jurisdiction where you don't know if the order has been passed by the AO, that is also in faceless, and who is going to conduct the appeal proceeding, that is also going to be in a faceless manner. So this scheme has been implemented and the matters are being heard in a faceless manner. So we saw in 246 subsection 1 what are the orders which are appealable before the Joint Commissioner of Income Tax Appeal. 246 capital A provides the list of orders which are against which you can file an appeal before the Commissioner of Income Tax. Now, please don't get confused. These are not the hierarchy that first you go to Joint Commissioner and then you go to Commissioner. These are two, so to say, either of the option you have to select. You can either go to Joint Commissioner or your appeal will go to Commissioner. If the order has been passed by the officer who is lower in rank, below Deputy Commissioner level, then of course you will have to go to the Joint Commissioner or the matter may get transferred. In case it is passed by the officer higher in rank, then you go to the Commissioner of Income Tax Appeal. The orders against which you can file an appeal. So the order passed by the Joint Commissioner under section. Now this Joint Commissioner is different than the Joint Commissioner appeals. So please do not get confused with the designations. An order passed by the Joint Commissioner under section 115 VP refusing to approve the option for tonnage tax scheme. In that case, you will have to file an appeal before the Commissioner. And see, there is a rationale to it. Now, in department, there is always a hierarchy. There is an income tax, let's say there is an inspector, then there is an income tax officer. Inspector doesn't pass the assessment order. He always assists his superior, which is an ITO, to kind of administrative affairs, drafting and all this. Now, income tax officer is the junior most, so to say, assessing officer. And then there are ranks, deputy commissioner, assistant commissioner, assistant, deputy, and then you have the joint commissioner, additional commissioner, commissioner, and then chief commissioner, principal chief commissioner. Now, it is not necessary that the assessment is done only by the income tax officer. Deputy commissioner may also do the income tax assessment under 143.3, joint commissioner or even the additional commissioner. Now, all of this is always appealable. Now, you cannot think of a situation where the joint commissioner level officer conducts the assessment and the appeal against the said order lies before joint commissioner appeal, because these two officers are almost parallel in rank. So appeal should always lie with an officer who is senior in authority, senior in experience. So for that reason, the appeal against the order passed by joint commissioner is consciously capped under section 246 capital A instead of section 246(1). Right? Here you won't find the situation where the order is passed by the joint commissioner and the appeal is also before joint commissioner appeal. That is not likely to happen. Whereas in 246 capital A, you have that jurisdiction because CIT is senior officer. The order against the assessee where the assessee denies his liability to be assessed under that, it could be non-resident, it could be the situation where you change the status of the assessee. 143(1), 200 capital A, 206 CB, which is again an intimation order passed under that. This is different. The order passed under section 143(3), except where the order is passed pursuance of the directions of dispute resolution panel. Now, we discussed earlier section 144C, where if the assessing officer is passing an order and if you are an eligible assessee, that is, in your case, there is any transfer pricing adjustment, or in your case, you are a foreign company. In either of these situations, the assessee has an option that when any adjustment is proposed by the assessing officer, then assessing officer has to pass a draft order. Against that draft order, the assessee can, instead of filing an appeal, he would file an objection before the dispute resolution panel. Now, DRP consists of 3 commissioner level officers. Now, commissioners will see the draft order passed by officer and then they will give the direction to the officer to conduct the assessment as per the directions. It may result into increase in addition, decrease in addition, or confirmation on the addition, whatever it is. Post DRP directions, the income tax officer passes the final assessment order. Now, against that final assessment order, logically, you cannot approach the CIT appeal. Why? Because in DRP, there are 3 commissioners who already go through the assessment records and the order passed by the officer, draft order. So, against the order which is reviewed by the DRP, Dispute Resolution Panel, which consists of commissioner, it is illogical to say that you can now file an appeal before commissioner appeals, because they are almost parallel authorities in terms of ranking. So therefore, they have given an exception here that yes, 143(3) orders are always appealable under section 246 capital A. However, there is an exception to that rule, and that exception says that if it is a situation where the order has been passed by the dispute resolution, has been passed pursuant to directions of DRP, in that case, you cannot file an appeal. Then the only option left is directly go to the Income Tax Appellate Tribunal. That we will see in the subsequent paragraphs. And likewise, in case the order has been passed pursuant to Chapter 10A, that is General Anti-Avoidance Rule. Now that GAR is also invoked only after seeking an approval of the commissioner. So again, in that case also, you have to reach out to the tribunal, which is the second level appellate authority, directly from the order of the officer. The same language almost follows if it is a situation of a reassessment. Just read it. Likewise, point number 6, an order made under section 92 CD modifying the total income of the relevant assessment year in accordance with the ALP as per the determined as per the APA agreement entered into. Rectification order under section 154 or 155 having effect of enhancing the assessment or reducing the refund or refusing to allow the claim made by the assessee under either of the said section. Again, there is an exception, and what the exception says, where the order of assessment or reassessment with the prior approval of CIT. An order made under section 263 treating the assessee as agent of a non-resident. Now, the mere fact that you treat a particular person as an agent of a non-resident, you can file an appeal against that order which holds so. This is irrespective of the assessment order which is going to be passed after holding you as an agent of a non-resident. So there are two things. If you are decided, or the order is passed that you are held as an agent of a non-resident under 163, then against that order we can file an appeal. The quantum addition which may happen during the course of assessment, that is an independent order by itself. Against that, again, you have to see whether that involves the DRP or not, what kind of matter it is, and then you can accordingly decide the appellate jurisdiction. So likewise, order made under 170, 171, 201, 206 CA. So all these orders are in short appealable before the Commissioner of Income Tax Appeals. There is an amendment made, substantial amendment made with effect from 1st September 2024 in relation to search and seizure assessment. Now, any order of assessment by the AO under section 158 BC for a search which is initiated by the department under 132 or books of accounts or other documents are requisitioned under 132 capital A. If the order is made pursuant to section 158 BC, in that case also you can file an appeal before the commissioner. Now, so these are the appellable order. Now the question arises, let's say yesterday we had a discussion where we saw that, we discussed that in case the assessing officer wishes to carry out a reassessment proceedings. So the section which is applicable for reassessment is section 147, and it is 148 under which the kind of a notice is issued to the officer, to the assessee, to file a return of income, then order is passed under 147. Now the question arises, as you recollect, we discussed that before carrying out a formal reassessment, that is before assuming a jurisdiction to carry out a reassessment, the assessing officer has to issue notice under section 148 capital A, which is inquiry before the reassessment. He has to first satisfy himself that yes, there is an escapement of income after considering the response of the assessee. So he issues the notice under 148 capital A 1, and thereafter he passes an order under 148 capital A clause D. Now the question arises whether the order which is passed under 148A capital D, is it appealable or not? And if yes, under which section you can file an appeal? Any answer? I already had given a hint as to what can be done against 148 capital A, but now I would want somebody to participate and provide the answer. If the order is passed under 148 capital A clause D, which holds that yes, there is an escapement of income and assessment proceedings or reassessment proceedings should be carried out. So what remedy is available under the law against that order to the assessee? Anybody? You can put the answer in chat box. If you want me to repeat the question, please let me know. If the order is passed under section 148 capital A, bracket into bracket D, clause D, what remedy is available against that order to the assessee? We have seen section 246 capital A. There is no such, kind of a mechanism because there is no such prescription about this section. All right, so I'll keep the answer on hold as of now. Do remind me once we complete this appellate procedure section, or if you get the answer in the due course. Form of appeal and prescribed fees. Now, appeal shall not be filed on a plain paper. There is a form which is prescribed, form 35A. For different, I think, appeals, there are different forms, form 35, 35A, 36, based on the jurisdiction, appellate jurisdiction, and there are different fee structure. The fee structure varies on the basis of addition which is made, the quantum addition. Where the total income of the assessee is 1 lakh or less, it is 250, and likewise there are slabs. Now, for all the matters where the amount is not involved, where the issue involved is something different, for example, treating the assessee as an agent of a non-resident. So in that case, quantum is not involved. So you have to file an appeal by paying a fees of rupees 250. And likewise for the penalties, it's not a quantum addition, it's a penalty. So irrespective of the amount, you have to pay the fees of 250 rupees for filing an appeal. Time limit. Now this is important. The appeal needs to be filed within a period of 30 days from the date of service of notice of demand. So when the notice of demand is served to you, you have to count 30 days from the date of service and file an appeal within that time. Now, in any other case, that is other than the case of assessment or penalty, because it is only when there is a quantum addition or there is a penalty, the department is going to serve the notice of demand. In any other case, there is no involvement of an amount like treating the assessee as agent of non-resident. Then the date on which intimation of the order sought to be appealed against is served. So, and you have to exclude the following time limit while computing the period of limitation. What is that time limit? If the order is passed under section, or if there is an application of section 270 capital A, let's say there is an assessment order passed. Now, assessing officer will, of course, after passing an order, as we all know, he will check whether it is a case of under-reporting of income or a misreporting of income. If it is an under-reporting, he will impose the penalty at the rate of 50% of normal tax liability on the under-reported income. Or if it is a misreporting, he will impose the tax of 200% of tax liability. Now, for all underreported income or penalty matters which are connected with the underreporting of income, the assessee is given an option that if he is going to accept the addition and he is ready to pay the demand, then the assessee can file Form 68 and seek a complete exemption or an immunity from the payment of penalty. So the proceedings will be dropped if the assessee is accepting the addition. However, it is only when it is a case of an underreporting of income. Misreporting, you do not have the immunity option. So what happens practically? You have got 30 days time limit to file an appeal. If you receive an order which has a demand and same time you received a notice for imposition of penalty, the assessee may think that, okay, if it is an underreporting related penalty, and if assessee feels that he does not want to litigate further, he will pay the demand. And if he is paying the demand, then he can file a form, get a complete immunity. But let's say if he has got a confusion or he wants to buy some time. In that case, the period of 30 days will always exclude the date on which the application is made. Let's say there is a possibility the application is rejected. Yeah. So the real reason is this. I file an application for immunity saying that I accept the addition and I'm ready to pay the demand. I file an application on a particular day, and if the officer does not pass the order within, let's say, 30 days, so the time limit of 30 days is gonna lapse. And if he passes the order rejecting the application for immunity, then I am at a loss. So therefore, the law says that the date on which you file an application for immunity and the day on which the order rejecting the application is served to the assessee, those days will be excluded to compute the 30 days time limit to filing an appeal. And this is quite logical step. Tax to be paid at the time of filing of appeal. No appeal to the Joint Commissioner or Commissioner appeal shall be admitted for consideration unless at the time of filing the appeal, in case where the return has been filed, assessee has paid the tax. So whatever income that you admit, you have to pay the tax first. It is only when you contest an addition, you have to say that, okay, I don't accept that addition. So at least whatever you admit to be your true income and you have filed the return, pay the tax. And in case where no return has been filed, in that case also you have to pay the tax or seek a waiver from the CIT. The procedure, I'm not going to spend time on this. It's quite straightforward, and you can easily kind of understand it. In the interest of time, we will just discuss some key provisions. Just go through it, and if you feel there is anything which requires discussion, we can have a look at it. Or any questions so far? All right. Now let us go to the next section 252 to 255, which is now a second level appeal, which is appeal to the Appellate Tribunal or Income Tax Appellate Tribunal. Now, the power to constitute an appellate tribunal is vested with the central government. It can appoint the judicial member and accountant member to exercise the powers to discharge the duties and functions under the Tribunal Act. So there is a separate act, ITAT, which governs the rules and procedure relating to the conduct of the proceedings before the tribunal. But this for all practical purpose, the tribunal deals with the matter arising under the Income Tax Act. What are the orders? So we have seen section 246 and 246 capital A. In a similar fashion, we have section 253, which provides the list of orders which are appellable before the Income Tax Appellate Tribunal. And any order which is out of this list or any action of the lower authorities which is not prescribed herein, that is not appellable before the tribunal. So if the order is passed by the AO, then you have got 143.3, a regular assessment or the reassessment. However, if the order is passed by the assessing officer under these sections, however, if that order is in pursuance of the directions of the DRP, and likewise, the order passed under 143.3 with the approval of this commissioner, where tax consequences have been determined pursuant to Chapter 10A, which is relating to general anti-avoidance rules, GAR, and likewise in relation to tonnage tax scheme, power of AO to exclude a tonnage tax company from the tonnage tax scheme if the company is a party to any transaction which amounts to the abuse of the scheme. So again, in these situations, the order which is passed by the AO directly goes to the Income Tax Appellate Tribunal without traveling to the Commissioner of Income Tax Appeal. Now coming to the situation where order is passed by the Joint Commissioner Appeal or the Commissioner Appeal under Section 250. Now this is nothing but you in a regular course of action file an appeal before Joint CIT Appeal or a CIT Appeal. They pass an order, and if you are still not satisfied with the order passed by the Joint CIT or CIT Appeal, you go to the next level, which is ITAT, and the order under which they pass the section under which they pass the order is 250. Likewise, penalty under section 270 capital A or 271A, if it is imposed by the CIT Appeal or Joint CIT Appeal. If you read those sections, the power to impose penalty is also given to the CIT Appeal. So all those penalty orders or even the rectification orders passed by the CIT Appeal, they are appellable before the ITAT. Now, please note that section 154 is relating to rectification of apparent mistake. Now, always be careful that it is not that any order passed under 154 is appellable before ITAT directly. It is only when this order is passed by the Commissioner Appeal or Joint Commissioner Appeal. If instead of Commissioner Appeal, if the assessing officer does the rectification, in that case, the only course available to you is approach to the Commissioner Appeal. And if the assessing officer passes an order under 154 pursuant to the directions of the DRP, in that case, again, the only option available to you is approach the ITAT. So it depends upon the section as well as the authority passing the order. Principal Commissioner or Commissioner. If any order is passed under 12AA in connection with the 12AA or AB approval. So we all know that a charitable trust can claim the exemption against its income if it is spending 85% of its income for charitable activity. Now, for claiming that exemption or deduction, it has to register itself under 12AA with the CIT, jurisdictional CIT. Now, that approval is not given by the normal assessing officer, which is IT or DCIT or ACIT. The authority to give an approval is with the CIT, and practically it is the CIT exemption who gives this approval. So, if they reject or if they refuse to grant or if they cancel the registration of a trust or institution under 12AA or AB, then the only option available is directly go to the tribunal. You cannot approach the CIT appeal. Why? Because Commissioner and CIT appeal are almost parallel. Likewise, ATG, it deals with the section, basically gives approval to the, again, an institution or a fund or a trust, whereby it can accept the donation and the donor can claim the deduction under section ATG while filing the return. So again, if the approval is not granted by the CIT to the trust or institution, they can file an appeal before the tribunal. Now again, please note that if an assessee is claiming a deduction under ATG in his income tax return and officer is denying that deduction, against that deduction, you always have to file an appeal before CIT appeal. It is only when The approval is not granted under ATG 5 subclause 6. It is only then that you have to approach the ITAT. Likewise, section 263, we are going to discuss it, and the penalty sections are there. So similar to section 12AA, you have 1023C. Now this section gives again the exemption to the trust institutions, educational, hospital institutions, all those institutions which want to claim the exemption under the series is given under 1023C, and the approval is granted by the commissioner only. So against any refusal or cancellation, you have to reach out to the tribunal only directly. What is the time limit for filing the appeal or the memorandum of cross objection under section 253? Now the appeal to the tribunal, so far the time limit was 60 days from the date on which the order, which is subject matter of appeal, is communicated to the assessee or the CIT. Now here they have used the word order is communicated to the assessee as well as to the CIT. Now we all know that tribunal is a second level appellate jurisdiction. So therefore the right to file an appeal before ITAT is available to both assessee as well as the commissioner. Now why the word commissioner here? It is very important to understand. In a normal situation where the order is passed by the assessing officer, additions are made, assessee has a right to file an appeal. AO cannot file an appeal because he is the one who is making the addition. So his order is always going to be against the assessee. So the first level is only available to the assessee. After assessee crosses the CIT appeal level, order may be passed against him or in favor of him. If it is passed in favor of him, then the right to file an appeal is given to the department. So it is the commissioner who passes an order against the order passed by commissioner appeal. Now please do not get confused here. The word here written is commissioner. It is not commissioner appeal. So these are two different authorities. If the order is passed by CIT appeal, then it is the appellate jurisdiction who is passing the order. And against that order, the commissioner can file an appeal or the principal commissioner before the ITAT, and he will represent the department before the ITAT. Or otherwise, if it is against the assessee can also file, and both of them can also file. The time limit, the earlier time limit was 60 days, but with effect from 1st October 24, it has been revised, and now it is 2 months from the end of the month in which order is communicated to the assessee. Memorandum of cross objection. Now there may be a situation where assessee files an application or an appeal before the ITAT, department will file a cross objection, or likewise, department may file an appeal and assessee may also file a cross objection. So this memorandum of cross objection has to be filed within 30 days of notice against which such order. Fee structure. So the maximum fee here is 10,000. As you can see, 10,000 is the maximum fee, 1% of assessed income. However, it is subject to 10 upper limit. And again, likewise, there are slabs which are given based on the amount of addition. However, if it is a matter relating to penalty or cancellation or registration or similar matters which are not quantifiable, the standard fee is INR 500. For cross objection, there is no fee. And for stay of demand, the fees is 500. We'll see the chapter, I think, concept of stay of demand. Rectification rights. Now, this section is different from section 154. This section 154 gives the rectification rights to the tax officer, or even the commissioner can pass an order under 154. Whereas this is a section where the tribunal can pass an order and may rectify any mistake which is apparent. However, it has to be passed within 6 months from the end of the month in which order is passed. And as we discussed in our previous session, the rectification can only be done where there is a mistake which is apparent from record. So if there is no apparent mistake, if a situation or a case involves a debatable view or a review, so there is a huge difference between review and rectification. Once an order is passed, you can only rectify it if there is an apparent mistake. Apparent means what? Immediately visible. On first sight, you find that, okay, 2 plus 2, 6 likha hua hai. Actually, that 2 plus 2, 4. It's an apparent mistake. Nobody is going to have a debate about it. And likewise, if there is any reliance on a judgment which is completely, a kind of against the department or in favor of revenue, but it has been interpreted extremely wrongly and it is apparent on the face of it, then yes, you can call for rectification of that order. Otherwise, not. The period within which order will be passed. Now, here it is important wherever it is possible. In every appeal that assessee files or the department files, the time limit is same. It is 4 years from the end of the financial year in which the appeal is filed. But then they are using the word wherever it is possible. Now, this indicates this time limit of 4 years is not a mandatory time limit, or it is just a directory time limit. So even if for whatever reason the tribunal has not been able to pass the order, it is fine. The matter will not be treated as a time bar. The tribunal can still continue to adjudicate that matter under its appellate jurisdiction. Now, let us discuss section 254 2A, which deals with the stay of demand. Now, why this section? See, when you clear two levels, like one is assessing officer passing an order and raising a demand, then you reach out to the commissioner appeals. Commissioner appeal passes an order, and in conformity with that order, the assessing officer again raises the revised demand based on the direction of CIT appeal. Now, there, demand is again crystallized. The assessee has to file an appeal before the tribunal. Now, when you approach the tribunal, we all know that for CIT appeal, there is a rule of 20% under the CBDT circular of 2016 and 17, that 20% of the demand you pay and rest is granted as a stay, but that is also subject to certain kind of a condition. Now, how about if you lose at CIT appeal level? So this section empowers the tribunal to grant the stay. However, the period has been fixed here. The stay is only up to 180 days from the date of granting of such stay, subject to the condition that assessee deposits again not less than 20% of the tax and interest. Or if it is a matter which involves payment of fees or a penalty or any other sum is payable under that, accordingly in that case also, the assessee is subject to 180 days stay, but 20% of it has to be paid. Extension of stay. Now, we have seen that tribunal is granted 4 years to pass an order, and in some cases, even if that 4-year threshold is not met, it is not mandatory that the tribunal loses its jurisdiction or matter becomes time barred. It can pass the order whenever it wishes to, subject to due process of law. Now, how about stay? We discussed that the stay will be operative only for a period of 180 days, and that too subject to 20% is paid by the assessee. What if the order is not passed within this timeline? In that case, the assessee may seek an extension for stay. However, if you can read it, no extension of stay shall be granted by the tribunal where the appeal is not disposed of within a period of 180 days. However, there are exceptions. The assessee is making an application and he has complied with the condition of depositing of tax of 20%, and the tribunal is satisfied that delay in disposing is not attributable to the assessee. Meaning thereby, assessee was always available. He always appeared before the department, before the tribunal to argue the matter. And in that case, the stay would be extended. But then there is an upper limit, and that is 365 days. If the matter is not disposed of within a period of 365 days also, then the law says that the stay will be vacated, meaning the stay which was granted by the tribunal, the extended period, that would also go away, and assessee has to deposit the complete tax. And that is irrespective of the fact that the delay in disposal of appeal is not attributable to the assessee. Delay was on account of adjournments which were sought by the department. Delay was on account of any reason which is beyond the control of the assessee, whatsoever reason. No extension in stay. But then there is one judgment of the Supreme Court in case of PepsiCo courts, where the court has observed that this provision is not in line with the constitutional mandate. If the delay in disposal of appeal is not attributable to the assessee, in that case, tribunal has a right or the power to extend that, to grant the extension in depositing of the tax. But that decision is rendered by the Supreme Court. So you have to give both the views. One, this is what the law says, and this is what the Supreme Court has said in a particular case. And accordingly, I think the complete picture will come. This is very, very important. Final fact-finding authority is what is called for the tribunal. Now, the ITAT is treated as a final fact-finding authority, which means that in any dispute, there are always questions of law, there are questions of fact. If it is a question of fact which is under dispute, then it is up to the tribunal only you can adjudicate. I mean, you can file an appeal. Once the tribunal decides or adjudicates upon the question of facts, then it is treated as a final answer. You cannot litigate it further. If you want to go to the High Court, then the issue should always be the question of law, and in fact, the substantial question of law. We will discuss the meaning of substantial question of law as we progress. So this is about benches. I think you can read it. Not much to discuss. So see, any matter which is pending before the tribunal, any appeal which is filed, it is always, the bench consists of two members. One is judicial member and accountant member. The accountant member is generally a chartered accountant having experience and qualification to be appointed as an accountant member, and the judicial member. So for both of them, there are different criteria. Judicial member is usually seen as somebody who has worked in the judiciary or who has been an advocate for a number of years, which is described. Now, this is practical. And both of them have to be there on as a division bench to listen to that matter, to adjudicate that matter under appeal. But in some cases where the appeal involves a total income which is computed by or does not exceed 50 lakhs, in that case, even a single member or the president of the tribunal, they can also kind of deal with that member. What if the members differ among themselves on a particular point or a particular issue during the course of disposal of the matter? So in that case, if the bench differ in the opinion on any point, that point shall be decided according to the opinion of the majority. If there are more than 2 members in the bench, then you have to follow the majority. If the members are equally divided, let's say there are 2 members and both of them are having a different view, or if there are 4 members, then it's 50-50 situation. Then they shall state the point on which they differ, and the case will be referred by the president of the tribunal for hearing by one or more other member of the tribunal, and then point will be decided according to the majority of the members who have heard the case, including those who first heard it. Anybody would want to suggest what is the meaning of substantial question of law? Now we are discussing section 260 capital A and 260B, which is filing of an appeal before the High Court.
Question of law basically means which is debatable, not previously settled by any other law of land or any court. And in order to be called as substantial, it should be of some worth, of some importance. So that's how it is.
Yes, yes. So, good attempt, Smriti. We will see the definition a little later, but yes, it is a nice attempt. The substantial question of law has got nothing to do with the question of fact, first of all. It is something which involves a debatable question of law, as you rightly mentioned. It is something which is unsettled, or it could be something where different points of views exist, and the court may be called upon to adjudicate that matter. So we'll see to it a little later what is exactly substantial question of law. So first, let us understand the provision. But yes, good attempt. Section 260 capital A. Now this provides that the appeal shall lie before the High Court from every order which is passed in appeal by the Appellate Tribunal, if the High Court is satisfied that the case involves a substantial question of law. Now, how this section 260 capital is different from the earlier sections, which is appeal before CIT appeal and tribunal. If it's a case of appeal before CIT appeal, you have got a list of orders. Only those orders are appealable before the first appellate authority. Likewise, for tribunal, we have seen the list of orders which are appealable before the tribunal. In case of a high court, the difference is there is not a prescribed list which is given. They are saying that every order which is coming from the appellate tribunal, that would be appealable before the High Court if it involves a substantial question of law. So it is every order. However, it is for the High Court to decide that whether it is a substantial question of law or not. So far as appeal before CIT appeal and tribunal is concerned, the only requirement is that there should be an aggrieved party, there should be some adjustment, there should be some action by AO or commissioner, which you are not happy with, and you can file an appeal subject to those objective conditions. In case of High Court, it is not the case. Once you file an appeal, High Court has a power to dismiss your appeal, saying that your appeal does not involve substantial question of law. Tribunal cannot do that. That I do not find this matter for whatever reason, it should be dismissed. No. Commissioner appeal can't do that. They have to adjudicate, they have to pass a speaking order. High Court has that power that High Court will say that, okay, we can't interfere in this matter because it is not a substantial question of law. Now, as we have seen, the department can file an appeal before tribunal. Likewise, against the order of the tribunal, the department, through principal chief commissioner or chief commissioner or a commissioner, it can file an appeal before the High Court against the order of the tribunal. The time limit is 120 days from the date on which the order appealed against is received by the assessee or the department, as the case may be. The High Court has a power to condone the delay if there is a reasonable cause or a sufficient cause is shown to the High Court. Now, we'll briefly come upon that question which we discussed a couple of minutes back, that order which is passed under section 148 capital A clause D by the assessing officer before he formally initiates the reassessment proceeding. So we have seen the provision of section 147 and 148, which says that before conducting the assessment or before conducting the reassessment under the section, the assessing officer has to first conduct an inquiry, and that is mandatory. After doing an inquiry, he has to issue the notice and seek an order seek a response from the assessee. And once assessee is filing the response to the show cause notice, he has to pass an order under 148 capital A D, holding that yes, this is a fit case for reassessment. Now, if the order is passed by the assessing officer under 148 D, that order is not appealable before CIT appeal, nor it is appealable before tribunal. Why? Because it is not explicitly mentioned in these sections. Therefore, the only way in which you can find a remedy, so it is a situation where there is no remedy available under the income tax law. So, under Constitution of India, the Constitution gives this right that you can file a writ petition before the High Court if there is no alternate remedy available to you. Now, this writ petition is filed under the Constitution of India. It is not filed under the income tax law, and the writ will lie before the High Court irrespective of the fact it is a substantial question of law or not. The only ground on which you will file a writ is there is no alternate remedy available. So under that route, you can approach to the High Court. So that was just an answer in relation to the question which we discussed earlier. I feel it is not part of the income tax curriculum that we are dealing with. So this is just procedural section. So likewise, in case of a tribunal, we had division bench, we have single bench. For High Court, the law says the appeal shall be heard by the bench of not less than 2 judges of the High Court. So it has to be a division bench. Now we shall move to what is the meaning of substantial. Okay, let's take the meaning of substantial question of law at a later stage, because that is part of the Q&A session. So we'll read it line by line and interpret each line. Appeal to the Supreme Court, Section 261. Now, against the order of the High Court, the final apex court is Honorable Supreme Court, from where you can file the kind of the appeal directly or a special leave petition pursuant to the provisions of the law. So these are the time limits. Just one important aspect in case of an appeal before the Supreme Court, and it is a procedural aspect. When you reach a High Court adjudicates the matter and it passes the order. If the order is not in your favor, the High Court has to give you a certificate procedurally before you can file the appeal before the Supreme Court. Special leave petition is what it is called. So it is only when the High Court gives you a certificate, you can file an SLP before the Supreme Court, otherwise not. Usually in all the cases, it is given. Time limit for filing the appeal. So this is just a summary of what we discussed. So as you see, the higher the forum, more is the time limit. So this is what we already discussed. So we are not going to get into it. So this is a smaller section. We have discussed this in our first session in great detail. So I would not want to take much of your time on this. Just go through it easy to understand? And let me know if you have any query. So purpose of this section is only to avoid the repetitive appeals when identical question of law is pending before the High Court or Supreme Court. So let us read now likewise section 158 AB. That was 158 was about repetitive appeal, avoidance of repetitive appeal, and here it is deferment of appeal by revenue where the identical question of law is pending before the High Court or Supreme Court. So if you want, you can understand this question concept through an illustration very easily. So this is an example which sums up the entire provision. Now, suppose a question of law, which is Q1, it has arisen in case of an assessee, Mr. X, and he received a favorable decision on question 1 from the first level authority. Now, in case of another assessee, Mr. Y, where the department's appeal on identical question of law, in his case, is pending before the High Court. Now, the department's appeal is pending before the High Court or, let's say, Supreme Court. And the Collegium of Commissioner is of the opinion that question 1, which is related to Mr. X, and question 2, in case of Mr. Y, they are identical. So the situation is, Mr. X has filed an appeal. He has received a favorable order from the CIT appeal on a particular question. And that question is a question of law, not of a fact. For Mr. Y, department on a similar question or on an identical question has filed an appeal before the High Court or the Supreme Court, and that appeal is still pending. Now, the commissioner thinks that for question 1 and question 2, they are both identical. Now, in this situation, if they again keep on fighting and filing an appeal, that creates a lot of pendency. So what the law says, it gives a flexibility. Section 158 AB can be invoked by the department to defer the filing of appeal in respect of question 1 in case of Mr. X to the higher appellate authority till a decision on question 2 in case of Mr. Y is communicated to the principal commissioner having a jurisdiction over that situation. Now, such a decision on deferment that will have to be subject to acceptance by Mr. X, that question of law is actually the same or an identical to the question of law involved in case of another assessee, which is Mr. Y. Right? Straightforward. Let us see some of the questions. Then we take a break and come back to section 263. Or maybe, yeah, let us see some of the relevant questions first. Then we have a lot to discuss here. Supreme Court decision in case of Genpact India. Now, is the appellate remedy by way of appeal before the first level authority under 246 capital A, is it available to a company which denies its liability to pay the additional tax under 115 QA? Now, if you read section 246 capital A, it says an order against the assessee where the assessee denies his liability to be assessed under the Act, or an intimation under 143(1), or an assessment order under 143(3) or 144. Now, the contingencies in 2 and 3, they arise out of assessment proceeding. Was the first contingency is a standalone in itself, and it is not dependent purely on the assessment proceeding under 143(3) or 144. The expression denies his liability to be assessed. It is very, very comprehensive to take within its fold every case where the assessee denies his liability to be assessed under the Act. This is what the court has held. Now, this is just for an information purpose, that with effect from October 24, the company is not required to pay the additional tax on buyback of shares that takes place on or after October 24. But this issue was in relation to a period where buyback tax was in force. So what the court held, that any determination under 115 QA, whether it is regarding the quantification or the question whether such a company is liable or not, it would be falling within the ambit of the first para, an order against the assessee where assessee denies his liability to be assessed under the Act. And therefore, the court said that 246 capital A remedy is available to the assessee. Now, let's go to the practical. Let's say hypothetically, if the court declines to interfere, then what? In that case, as I discussed earlier, the High Court has wide powers wherein a writ petition against any order passed by authority is maintainable before the High Court, provided there is no alternate remedy available. Now, in this case, the assessee has already kind of approached the Supreme Court, and court has held that yes, 246 capital is available to the assessee, so he will resort to the alternate remedy provided under the law. Now, this is about putting an additional or a new claim before the appellate authority. Is it permissible under the law? Now, the question was raised in the case of Prithvi Brokers and Shareholders, Bombay High Court decision of 2012, a very celebrated case law. See what the court has held. Court says that additional grounds can be raised before the authority, even otherwise than by filing of return of income. Now, all your claims, exemption, deduction, you have to raise in your return of income. If you have not claimed anything in your return of income, can you raise it from the assessing officer? We have got favorable ruling. Yes. Likewise, the question here is, can you raise it before the appellate authority? The answer is yes, you can raise it before the appellate authority. However, this is conditional. In case an additional ground was raised before the appellate authority, which could not have been raised at the stage when the return was filed, or when the assessment order was made, or the ground became available on account of change of circumstance or law, the appellate authority can allow the same. Now, additional grounds can be raised before the appellate authority, even otherwise than by way of filing of return of income. However, in case the claim has to be made before the AO, the same can only be made by way of filing of revised return of income. So, please bear in mind the distinction between claim and ground. Now, let us see the definition of substantial question of law. So, this we discussed, Pepsi Foods Limited, Supreme Court decision. Power of tribunal to grant the stay beyond a period of 365 days. So I'm just moving directly to the important one. What do you mean by the term substantial question of law? There is a specific question which has also been asked in the past examination. Question number 5, let us try to understand how the courts have defined. Now, please note that this is not a definition which is coming out of Income Tax Act. It is purely coming out of the judgments which have been rendered over a period of time. And this is not an exhaustive definition. It is an inclusive one. The expression substantial question of law, it has not been defined. It has acquired a definite meaning through various pronouncements. And the pronouncements have laid down several tests. One is whether it directly or indirectly affects the substantial rights of the parties, whether the question is of a general public importance. Now, it's a very wide term, general public importance. Any issue which is going to have a bearing in a large number of cases, even if it involves ascertaining the facts, it still takes the color of a substantial question of law. Where it is open where it is an open question in the sense that issue is not settled by the pronouncement of the Supreme Court, Privy Council, or the Federal Court. Or the Privy Council and Federal Court, these concepts are not there. They are the judiciary concept prior to the independence. The issue is not free from difficulty, or it calls for a discussion of alternate view. So, as somebody had earlier mentioned, if it is a debatable view or if it involves an alternate view. So, this is the test on the basis of which you have to decide whether a particular matter is a substantial question of law requiring the interference of the High Court. So I think we may now take a break for 10-15 minutes, and only then we should start the next topic, that is section 263. And 264, revision and order. Ashokji, shall we take a break? Okay. Yes. So we shall now discuss section 263 and 264, which is a revision of orders. So first, section 263, revision of order which is prejudicial to the interest of revenue. Now, what happens generally? The brief background and the reason for this section. Assessing officer usually carries out the scrutiny assessment, reassessment, and different kinds of proceedings under the Income Tax Act. Now, it is the principal chief commissioner who is the authority superior to the assessing officer. And procedurally, how it happens, once the assessment is framed, that is, order is passed, all the papers relating to assessment, they are, internally kind of reviewed by the officer senior in rank, which is the commissioner, which can be principal chief commissioner, principal commissioner, or normal commissioner. Now, during the course of their review, if they find that if there are any serious lapses and the conditions under section 263 are satisfied, and if the assessing officer has kind of overlooked certain areas, or if he has kind of overlooked certain key principles or key judgments, or there is a lack of inquiry under the law, then the commissioner can invoke the provisions contained in section 263 of the Income Tax Act. Now, let us read the verbatim of the section. Under section 263(1), if the principal chief commissioner or chief commissioner, principal commissioner or commissioner, if he considers that any order passed by the AO or the TPO under section 92 CA, TPO basically the transfer pricing officer carrying out the transfer pricing assessment, if it is erroneous, insofar as it is prejudicial to the interest of revenue. So there are two conditions. The order passed by the officer is erroneous, and it is also prejudicial to the interest of the revenue. In that case, the commissioner, after giving assessee an opportunity of being heard, and after making inquiry as he may deem fit, he may pass an order which may result into enhancement of the addition, modification of the assessment, cancellation, and direction for the fresh assessment. Now, he may enhance or modify, like increase the demand or increase the addition amount. But when it comes to cancellation, he may cancel, but at the same time, he will direct for the de novo or the fresh assessment in case of an assessee. Now you can see cancellation means at the same time direction. It can't be standalone only cancellation, which indicates that he cannot give a relief to the assessee under section 263, because section 263 can be invoked only when there is an order which is passed by the officer, AO or TPO, which is erroneous. The order contains an error and it is prejudicial to the interest of the revenue. Now, section 263 is definitely different from section 154, which deals with the rectification of apparent mistake. In 154, what we do is we rectify a mistake which is apparent from record, and it is the same officer who has passed the officer and got a power to rectify. Whereas 263 essentially does not do the rectification of an apparent mistake. It modifies the assessment, or it results into cancellation of an existing assessment and direction for a de novo assessment. And that is only on account or where a situation which should favor the revenue. Like the order passed by the revenue means income tax department. The order passed by the assessing officer is prejudicial to the interest of revenue. 154 deals with apparent mistake, but at the same time, it gives the liberty to either pass an order which reduces the demand or rectifies the demand to a lesser burden, or it may kind of give the relief to the assessee from an adjustment. Whereas under 263, you can't give a relief to the assessee. It has to be a revision by the CIT, which results into an upward adjustment for the assessee. Now, there was a lot of litigation, so far as the word erroneous and prejudicial to the interest of revenue is concerned, so then the government has now tried to, kind of insert a separate section, a deeming section, which means that in certain situations, it will be deemed that the order passed by the assessing officer is erroneous. Now, what are those situations? Any assessment order which is passed without making inquiries. So if the officer has not done verification or if he has not carried out inquiry, it would be treated as an erroneous and prejudicial to the interest of revenue. Any order which grants relief without inquiring into the claim. Any order which has not been passed as per the directions of the CPDT. Now, we all know that the directions and instruction of the CPDT under 119, they are mandatory for the department to follow. If they fail to follow or observe the direction, it results into invocation of section 263, and it shall be deemed that the order passed by the AO is erroneous. Any order which has not been passed in accordance with the decision which is prejudicial to the assessee rendered by the jurisdictional High Court or Supreme Court. So on a particular issue, if there is a view of a High Court or a decision of a High Court or a Supreme Court, and High Court should be a jurisdictional. A non-jurisdictional High Court does not require the invocation of 263. Let's say if I am an assessee of Gujarat and there is a decision of a Bombay High Court in favor of revenue and there is no decision of a Gujarat High Court. In that case, the commissioner in Gujarat cannot invoke the 263 if the tax officer or the assessing officer is granted the favor to assessee. It is only when the jurisdictional High Court decision is in favor of department and assessing officer has overlooked that decision, then CIT can invoke 263. And again, please note that the para 2 talks about the deeming fiction, which means in these situations, it shall be deemed that the order passed by AO is erroneous and prejudicial to the revenue. It is not an exhaustive list. No order shall be passed after the expiry of 2 years from the end of the financial year. In computing this limit, the time taken in giving the opportunity to the assessee to be reheard under 129 or any period during which revision is stayed by the court or injunction of any court, it shall be excluded. Now, again, one interesting question, because we have discussed the appeal proceeding. Now, if the assessment is carried out pursuant to the invocation of 263, then the appeal against that order shall lie before the ITAT, Income Tax Tribunal. What if, consider a situation, assessment is carried out by the tax officer, an assessing officer. Against that assessment, assessing officer, let's assume that he has not carried out the inquiry. So the case is there, invocation of 263 is possible. CIT is going through the file and he is issuing a show cause notice to the assessee that why revision proceedings should not be undertaken in your case. Now, this is just a show cause notice. Assessee files an objection against the show cause notice, and not the CIT appeal, but the CIT who has invoked 263 is going to dispose of those objections. Now, against that disposal, what is the remedy available to the assessee before the appellate form? Can he file an appeal against 263 directly to the tribunal? The assessment is not carried out. It is just at the preliminary stage. And this is, I am all sharing with you the practical insight, how it really happens. When an assessment is done by the assessing officer under 143.3, the CIT goes through the files. If he feels there is a lack of inquiry or the conditions of 263 are preliminarily satisfied, he will issue a show cause notice to the assessee why 263 in your case should not be done. Assessee will file an objection that for so and so reason it should not be done. After that, the CIT will pass an order that no, I am going to proceed with the 263 invocation. Against that order, the assessee has got no remedy under CIT appeal or Tribunal, High Court, Supreme Court, no appeal. In that case, the practical remedy is filing a writ petition before the High Court, jurisdictional High Court. So this is just for your knowledge and completeness purpose. Once, let's say, you do not file a writ petition before High Court, or you file a writ petition and you lose, then the CIT is definitely going to invoke 263 and assessment will be carried out de novo, or there will be a modification of assessment by the officer. In that case, a revised assessment order will be passed, which will be called order passed under 143.3, read with section 263, or an order passed under 147, read with section 263. Whatever may be the original order, that number would be quoted, that section would be quoted along with section 263 because it is pursuant to the mandate given in 263. Against that, you will file an appeal before the tribunal, not before the CIT appeal. Now, this is also an interesting section, section 264. A revision of other orders. Now, 263 is possible, as we understand, only when the revision is basically to deal with a situation where the order is prejudicial to the interest of revenue. Whereas 264 is when the order is not prejudicial to the revenue, which means when the order is passed by subordinate authority, principal chief commissioner or chief commissioner may either on his own, that is suo motu, or upon receipt of application from the assessor, they may call for the record of any proceeding in the course of which order was passed. Now then the commissioner will do his own study of the matter, and then if he finds that no, in this case, the 264 can be invoked, then he can invoke suo motu, or he may invoke it upon receipt of the application from the assessee. Now, there is a limitation. The CIT cannot or is not empowered to revise the order on its own, that is suo motu, if the period of more than 1 year has expired from the date of order which is sought to be revised. So this is just a limitation period. If the application for revision is made by assessee, it must be made within 1 year from the date on which order in question was communicated, or the date on which he otherwise comes to know of it, whichever is earlier. Now, please note, see how the things work. If assessing officer is passing an order under 143.3, if he is overlooking out of oversight or whatever reason, out of negligence or for whatever reason, he has granted some favor to the assessee and there is because of lack of inquiry. 263 can be invoked by the CIT and it has to be on his own. It is not upon request made by assessing officer or by the assessee. He has to invoke on his own. 264 is applicable only in a case where the order is not prejudicial to the revenue. That is, the assessing officer, the CIT may call for the record of the proceeding and he may see that, okay, this is something, there is some lapse on account of assessing officer and this has resulted into assessee being in a disadvantageous position. Some addition has been made which should never have been made. So he can correct the things on his own, or the assessing officer and the CIT can also be requested by the assessee to ensure that the order is revised under the provision of 264. So this favors the assessee. Now here there is a question. When the officer is passing an order, the assessee has already an option of filing an appeal before CIT appeal. So is it compulsory for him to first exhaust the remedy of 264 and then go to CIT appeal? Or whether he has got both the options available, that he can file an appeal before CIT appeal or he can file a revision before 264. Or third, whether first he has to exhaust appeal mechanism and then go to 264. So I would want answer from the students on this question about the interplay between 246 capital A and 264. Anybody? Or should I repeat the question? Should I repeat? What is the interplay between 246 capital A and 264? Now see, here is the answer. The commissioner is not empowered to revise any order in the following cases: where the appeal against the order lies to the joint commissioner appeal or the commissioner or the tribunal, but it has not been made and the time within which the appeal may be made has not expired. Or in the case of an appeal to the joint commissioner appeal or the commissioner appeal or to the tribunal, the assessee has not waived his right to file an appeal. Right? This is A. Situation B, where the order has been made subject to the appeal or joint commissioner appeal, or to the tribunal. So this means if you have already filed an appeal before the appellate authority, whether it is the tribunal or the commissioner appeal, you cannot approach the CIT at the same time to invoke the 264 to give you a relief. Alternatively, if the time limit within which the appeal is to be filed has not expired, or you have not voluntarily kind of surrendered to say that, okay, I'm not going to file an appeal, you have not waived your right to file an appeal, in that case, you can approach the 264. Say, for example, the time limit for filing an appeal before CIT appeal is 30 days. So once the order is passed, let's say order is passed on 30th of May, and you have to file the appeal before the CIT before 30th of June. Within these 30 days, if you want to file an appeal, if you want to file an application for revision, then you can file an application for revision only when, number one, you have not filed the appeal before CIT appeal. So you can't have two remedies and you can't explore the two remedies for a same issue. This is called as a forum shopping. You can't say that I'll explore this also, I'll explore this also. No, you can choose either of, number one. Number two, if those 30 days, that is till 30th June, you can't file a petition for revision before the CIT, or if you want to file within 30 days, then you have to give it in writing that yes, I am waiving my right of filing an appeal under 246 or 246 capital A or under 253 before the tribunal. Point 456 is procedural. Just go through it once. Again, this para number 3, limitation of time, it is also a procedural one. Just go through it, and if you have any query, we can discuss. Otherwise, just an informative para. faceless revision. So 264 capital A, like we have seen in assessment proceeding, in appeal proceeding. So in 264 capital A, there is an enabling clause which has been inserted. It is an enabling section which basically empowers the central government to make a scheme to introduce the faceless scheme of revision under the Income Tax Act. So the purpose of faceless revision would be to eliminate the interface, like you don't know who is going to be the commissioner who is going to exercise the jurisdiction to act on your petition. And likewise, it can be allotted randomly to any non-jurisdictional CIT as well. And you don't have any access. Now, this is also very important, and 264B procedurally carries a lot of importance. How it is happening right now and what this section proposes. So, you file a return of income that is processed under 143(1). Then, if the case is picked up for scrutiny, the scrutiny assessment goes under section 143(2), 143(3), or if it is a reassessment, then 147, read with 148. The AO will pass an order. Against that order, you file a petition before or an appeal before CIT appeal, or you file an application before the CIT under section 264. Alternatively, you may also file an application before tribunal if it is in relation to those specific orders where you have exhausted your remedy before the dispute resolution panel or whatever it is. Under all those situations, when you are under an appellate mechanism, the appellate authority will pass an order. They will either give you a benefit, that is, they will pass an order in favor of you and they will give you a relief, or they may give a partial relief and partially they disagree, or they may completely disagree with you and they sustain the order of lower authorities. Once the order of an appellate authority is there, then it is obligatory on the part of tax officer to give effect to those orders. To give effect means pass one more order giving effect to the order or directions of the higher appellate forum. Could be CIT appeal, tribunal, could be commissioner under 263 or 264, it could be High Court, it could be Supreme Court. So all those orders would either be in your favor or against you, irrespective they have to pass an order. Now this is so far being done manually by the jurisdictional assessing officer. Even if you face an assessment in a faceless manner, once the order is passed, let's say by CIT appeal, you get this order in your hand. Now, if you want to implement this order, you go to your jurisdictional officer who is in your area, local area, you sit with him and get the order passed. But now they are introducing the faceless effect of order, which means you can file an application online. You don't know where the order will go and where your application will go. And in a dynamic jurisdiction, your petition would be, petition for appeal effect would be allotted to some random officer, and he is going to conduct the appeal effect proceedings, so to say, or the appeal effect procedure in a faceless manner. And he'll do all those computation, whether there's a refund, whether there's a tax liability or not. All those reliefs and everything will be carried out in a faceless manner under dynamic jurisdiction. So this is about the timeline for revision under 263 and 264. Just go through it. I think there's nothing much to be discussed here unless you have got any query. So if it is a 263 matter, the time limit is 2 years from the end of the financial year in which order is sought to be revised was passed. And in case of 264, 1 year from the end of 1 year from the date of order in case of a suo motu revision. Whereas assessee submits an application The time limit is 1 year from the end of the financial year in which application is made. So this needs to be remembered. What time you need to exclude? That is time taken in giving an opportunity or period during which the stay has been granted by the court. Question should come in your mind. Why would a court give a stay? From where did the court come into this picture? So just think it logically. The assessing officer is passing an order. The order is sought to be revised by the 263 order by the CIT. Why would court state, and from where the court came into picture? Neither the department can go because department is initiating 263, so it is not going to go to the court. Assessee, can it go? If yes, under what circumstance? Section 260 capital we already read, appeal to the High Court. You can appeal to the High Court only against the order of tribunal, which involves substantial question of law. Can you file an appeal before High Court or Supreme Court if the CIT is giving an order which is, if CIT is initiating a revisionary proceeding? Answer is no. So this is where the provision says that the period during which any proceeding is stayed by a order or injunction of any court, and the logic is very clear. You file a writ petition before the court. In a writ petition, you ask the court that you have got no alternate remedy available under the law, so you are directly approaching the High Court to exercise your constitutional remedy. And if the High Court feels that no, something wrong is going, so High Court may direct that, okay, the matter may be stayed until the High Court is completely studying the matter and giving the final order. And if after studying the matter, High Court, after listening to the party, if High Court decides that 263 is invalid, they will ask for dropping the 263 proceeding. If they say no, 263 is valid in this case, they will again allow the department to carry on. So whatever time it takes, whether it is 1 year, 2 year, or 5 years time to adjudicate that matter by the High Court, that time limit will be excluded to compute this. So these questions should, come in our mind as to how come out of blue the court comes into picture in a matter of 263. So this is how it is. Non-applicability of time limit. The order in consequence of or to give effect to any finding or direction contained in the order of ITAT, High Court or Supreme Court. So in those circumstances, it is the direction of the court which is coming. So 263 time limit doesn't apply. Now let us discuss monetary limit for regulating the filing of appeals by the Income Tax Authority. Now this section is exclusively for the Income Tax Department. What does it say? Now, what was seen earlier that, as we know, the appeal before the first appellate authority, that is CIT appeal, is always filed by the assessee. So this monetary limit is not applicable in relation to appeals before CIT. So whenever department wants to file an appeal for ITAT, High Court or Supreme Court, there is always a threshold which is given or set under section 268 capital A, read with the CBT circular, where the CBT says that, okay, if the amount involved, if the tax demand or tax effect involved is up to a certain limit, you can't file an appeal before the High Court or Supreme Court or the tribunal, whatever it is. And if it is lesser than that, you have to kind of stay away from filing an appeal. Don't kind of overburden the judiciary, or for whatever reason, assessee has got a success at a lower level, let it be the final. But that does not mean the department has accepted the verdict for all the cases. So let us see the provision. Just read it line by line and we discuss the key provisions. So let's see the monetary limits. These were the limits prior to the revision by circular number 9 of 2024. So these are the limits. So if the department wants to file an appeal before tribunal, the tax effect has to be 50 lakh or more. And likewise for High Court and Supreme Court, it was 1 crore and 2 crore. Now this has got increased from 50 lakh to 60 lakh, from 1 CR to 2 CR, from 2 CR to 5 CR. So you have to remember these limits as applicable in your respective examination. Now, if the tax effect, we will see what is the meaning of tax effect. If it is below these threshold, the department cannot file an appeal before the tribunal, High Court or Supreme Court. Now, this is very important to note that the law clearly says that merely because department has not filed an appeal, it shall not be lawful for an assessee to contend that tax authority has acquiesced in the decision on the disputed issue by not filing an appeal. So in a particular case, department may not file an appeal because of monetary threshold. It does not mean the department accepts the verdict of the either tribunal or High Court or Supreme Court or the CIT appeal. It does not mean that. It simply means the department has not filed appeal due to direction of the CBDT, considering the monetary limit or a monetary threshold or the materiality threshold set by the CBDT. But then there are certain exceptions. The decision to file an appeal shall be taken on merits without regard to the tax effect and monetary limit. So in following cases, the department can file an appeal without regard to the monetary limits which are fixed above. What are those limits? Where any provision of the act, rule or notification has been held to be constitutionally invalid. Let's say you file an appeal before a High Court and you say that, okay, let's say for example, section 14A is constitutionally invalid. It is held by the High Court that this section is constitutionally invalid. That means the High Court has struck down the law completely, as if the law should not be followed. This is not a law at all. Now, in that case, it has a larger implication. So the CBDT has clearly said that in these cases, you have to completely ignore the monetary limit, even if it is insignificant amount. You can challenge it. It's not you have to, but you can challenge it. That is, department can challenge it before the higher level. Now, constitutionally, a provision is valid or not, that is only decided by High Court and Supreme Court. Tribunal cannot pass an order saying that the provision is constitutionally invalid, because tribunal is a creature of law and courts are creatures of constitution. So tribunal can only adjudicate the matters and it cannot decide upon the validity of the law itself. Second, where any order, notification, instruction has been held to be illegal or ultravirus. So similar to the act, rule, or notification, where the order, instruction, notification, circular of the board or the government of India has been held to be illegal or ultravirus. Now, this is similar. The tribunal can't do it, only High Court or Supreme Court can do it. So you can challenge it to the next level. So in similar fashion, the situations have been carved out. You can just read it, and if you have any query, we can discuss each of those. So these are all intelligence and investigative agencies through which, if the if the matter is connected to any of these, then there is a likelihood that you can't take a shelter of this limitation. Where the prosecution has been filed by the department, where the tax effect is not quantifiable or it is not involved. the tax effect is not quantifiable or not involved, such as registration of trust, etc. In those cases, monetary limit, of course, it can't be applied also. Where it relates to undisclosed foreign income or undisclosed foreign assets, cases involving tax evasion, including cases of bogus capital gain or loss through penny stock and cases of accommodation entries, where mandated by a court's direction. When the court directs you to file an appeal, then of course, writ petitions, matter relating to wealth tax, fringe benefit, equalization levy. These are all the exceptions. You can read it. So I'm not getting into computational aspect right now. Yeah, this is issue important. Manner of calculation of tax effect for different. Okay, fine. Just read it. And if you have any query, we can kind of discuss it. So this is basically what we discussed. It is the duty cast on the commissioner to specifically record that even though the decision is not acceptable, appeal is not being filed only on the consideration of the tax effect is less than the monetary limit. There will be no presumption that the department has accepted in the decision on the disputed issue. Right? And likewise, in those cases where the department has not filed an appeal because of the monetary threshold, it shall not be taken to be a precedent value. Meaning thereby, precedent value means what? Precedent value means, let's say, when I am filing an appeal, I rely on various case law to support my contentions. One of the contention, can I take it like that in a particular case, department has not filed an appeal, which means department has accepted this issue to be in favor of assessee. So the same situation should follow in my case. Can assessee take an argument? The answer is no. Why? Because in such cases where the appeal is not filed merely on account of low tax effect, those cases will have no precedent value. Then there was one circular in the year 2019 where the circular has very specifically clarified that the cases involving bogus capital gain through penny stocks, in those cases, irrespective of the time monetary limit, the CBDT has directed the field officers to file an appeal before the higher authority if any of the lower authority has granted the relief. Now, question comes, what do we mean by long-term or short-term capital gain through penny stocks or bogus capital gain? So, the law earlier was that all long-term capital gain arising on account of transfer of shares and securities which are listed on stock exchange and where the assessee has paid the securities transaction tax, those capital gains were exempt income. Then the law brought down the tax rate to 10% and then to 12.5% again increased. So whatever it may be, the long-term capital gain was exempt earlier. So the instances were identified where the value of a stock was artificially increased. Like, for example, you find a company which is a dummy company or a bogus company that gets listed on the stock exchange. then artificially the price of the share gets increased, and through that, let's say you invest 1 lakh rupees, but probably in a day's time your money becomes 5 times or 10 times. So you invest 1 lakh, but you sell it for 10 lakh rupees in a period of less than, let's say, 1 month or 2 months. And all those transactions which are artificially created, they are dummy transactions just to earn a bogus long-term capital gain, to convert your black money into a white money. Now, these instances were identified. So the court highlighted that the CBDT said that in these cases, the chances of success for the department are significantly higher. So then this circular came clarifying that monetary threshold are not to be followed in these cases, and appeal has to be filed if the assessee has earned any kind of a positive order from the officers or lower appellate authorities. Now the final topic for this chapter, doctrine of partial merger and doctrine of total merger. Now let's try to understand this doctrine through this chart. What is partial merger and total merger? Now, normally when the assessing officer is passing any order, that order can be rectified under 154, or that order can undergo a revision under section 263. Now, when the order is rectified, the order is amended and the mistakes are rectified. Section 154 specifically provides that rectification can be done only in relation to apparent mistake. But at the same time, if there is any issue which has been subject matter of appeal before the appellate authority, that issue cannot be rectified even if it involves an apparent mistake. The same is the case in relation to 263. If the matter has been pending before the higher authority in an appeal, then CIT appeal on that issue at least cannot undertake the revisionary proceedings. Whereas in case of section 264, the situation is different. If on any issue the appeal is pending before a higher authority, that is joint commissioner appeal or commissioner appeal or tribunal, there cannot be invocation of 264. So this is called as doctrine of total merger versus partial merger. Now in case of 154 and 263, you cannot undertake the revision or rectification only in relation to those issues which are subject matter of appeal. The issues which are not the subject matter of appeal, you can still do the 154, you can do the 263. And once you do the 154 and 263, those orders get merged with the original order. So the original order remains. So this is a partial merger. Whereas in case of a total merger, once you file an appeal before a higher authority, then 264 ceases to exist. Your whole assessing officer's order gets merged with the CIT appeals order, even if there are unrelated issues involved, right? So this is basically the concept of merger. Now let us see some of the judicial precedents. Just read the issue first and then we deliberate on the answer. The answer is there before you, but let's try to understand the key areas. Now you can see the observation of the court. See what the court says. Once an order of assessment is reopened, the previous order of assessment will be held to be set aside. The whole proceeding would start afresh, but the same would not mean that even when the subject matter of reassessment is distinct and different, the entire proceeding would be deemed reopened. It only means that in a case where the issues before the commissioner at the time of exercising 263, if that relate to the subject matter of reassessment, would the limitation start from the date of reassessment order. If the subject matter of reassessment is distinct and different, in that case, the relevant date for the purpose of determining the period of limitation would be the original assessment order. So this is, some way the doctrine of partial merger, where original order still exists. Accordingly, the court in this case held that the commissioner exercising the jurisdiction under 263, the powers under 263 relate back to the original assessment order, which were not covered in the reassessment. And therefore, the limitation would start from the original and not from the reassessment. So once the reassessment is carried out, it does not mean the original assessment ceases to exist. Yes, the issues involved in the original assessment are different. It is presumed here, and in the reassessment, there might be certain additional issues. And therefore, the reassessment order does not entirely override the original assessment order. Both coexist, except that in reassessment order, there are certain additional issues which might have been examined. Genpact ruling we already discussed, so I'm not getting into it. Prithvi brokers and shares we discussed. This is also an interesting one, Madras High Court. So this is a revisionary class. We are here today. So any difficulty, anywhere you find you have a question, so this would be your last chance, because otherwise you'll have to, see the earlier recordings and you may not have a live session to discuss your queries. So whatever queries you may have relating to this topic, we can surely discuss it right away. So whether the tribunal has the power to review or reappreciate the correctness of its earlier decision. So here, I think the power to review is not there with the tribunal, nor with the CIT appeal also. It is only when there is a mistake apparent on record, the tribunal can restrict itself to those parameters. If there is no mistake apparent on record, tribunal cannot kind of review or reappreciate or recall its order. Otherwise, what happens? The exercise would be endless. Today, there are Mr. X and Mr. Y who are heading the bench. They are passing an order. Tomorrow, you will have someone else. He will also do the revisionary. He will also do the review of the order which was passed by the predecessor. And likewise, the day after tomorrow, you will have someone else. So this process may continue endless and the litigation may never attain the finality. So in order to do that, you will find that the power to review and reappreciate is not given to the appellate authority. It is only that it can do the rectification of apparent mistake within the parameters of the law. 254(2) is not a mandate to unsettle the decisions taken after the due reflection. This is similar. So we are not discussing these judgments, which are almost, yeah. This is, very, very important one, which I think I already touched upon during the discussion, that whether the automatic vacation of stay order upon expiry of the extended period of stay of 365 days be valid and where the delay is not disposing is not attributable to the assessee. So see what the court says. Court says that Supreme Court says that third proviso to 254 2A provides that the appeal filed before the tribunal is not disposed of within the period of stay, which is 180 days, or extended period of stay granted by the tribunal, which is 365 days, then the order shall stand vacated after the expiry of 365 days, even if the delay in disposing is not attributable to the assessee. So if delay is not on account of assessee, even then the order will vacate, stay order will vacate, and you have to pay the 100% demand. But this is where the court intervened, and court says that appellate tribunal, wherever possible, has to hear and decide the appeal within a period of 4 years. It is only when a stay is granted by the tribunal, the appeal is required to be disposed of within 365. So for a disposal of an appeal by the tribunal is concerned, this is a directory provision. However, the condonation of automatic vacation of stay becomes mandatory so far as the assessee is concerned. The court pointed out that the said proviso would result in an automatic vacation of stay upon expiry of 3 days, even if the tribunal could not take up the appeal in time for no fault of assessee. The vacation of stay in favor of department would ensure even if the department is itself responsible for delay. Now, and therefore, the provision is entirely manifestly arbitrary, being a provision which is capricious, irrational, and disproportionate so far as assessee is concerned. And this is, quite apparent from the judgment of the court and from the provision itself that even if there is no fault of assessee, the tribunal has, delayed it, or for whatever reason, if the delay is not on account of assessee, in that case, the assessee should not suffer. So therefore, the court has said that the provision shall be amended to the effect that the order of stay shall stand vacated after the expiry of period mentioned in the section only if delay in disposing is attributable to the assessee. The court, from negative, the court made it a positive tone provision. Now, this is also important, whether the High Court has the inherent power to review its own order to correct a mistake which is apparent from record. Now, the answer is yes. High Court can review the order. Now, this is not explicitly given or available for the tribunal. This is only for High Court and it comes from the decision of Supreme Court. When there is a discovery of new or important matter of evidence or evidence which, after the exercise of due diligence, it was not within the knowledge of petitioner or could not be produced by him. Where there is a mistake of record, so there is no dispute about it, or if there are any other sufficient reason, and it is for the court to decide what are those sufficient reasons. In the following situation, the review will not be maintainable when there is merely a repetition of old and overruled argument, or where there is a minor mistake of inconsequential import. So if there was any minor mistake in drafting of the order or during the proceeding, if there was a procedural lapse. So in those cases, it is not going to revive the matter or it will not require the review of the order. So this is similar. So I'm not touching on the delay in filing of appeal. So see, you just have to bear a thumb rule. The court has been given the power to delay or to condone the delay in filing of appeal or a petition if the assessee has got a reasonable cause. Let us now discuss the chapter 15 is done, 16 is done. We may now discuss chapter 14. Just give me 1 minute. I'll just. Yes, here we go. So this chapter is relatively small. 131 to 136, we will, separately have a discussion with the miscellaneous provisions related chapter. So today we can discuss the income tax authority, appointment and control, jurisdiction of the tax authority. Then we'll also discuss taxpayers charter and disclosure of information under 138. And wherever we'll discuss the relevant procedural section. So appointment and control. So under the Income Tax Act, CBDT, that is stands for Central Board of Direct Taxes. That is the body which is constituted under the Central Board of Revenue Act 1963. It has a chairman and it has its members. Now this CBDT comes and works under the direct jurisdiction of Ministry of Finance, and it is appointed to administer the law relating to Income Tax Act. So this is the hierarchy. You can see we have discussed that it all starts with the inspectors of income tax at the lowest level. They do not pass any assessment order. Then there are tax recovery officer. They are also not the ones who carry out the assessment. The assessment is carried out mainly by the income tax officers, which you can see in serial number 10. Then you have got commissioners, which is deputy commissioner, assistant commissioner. They carry out the assessment. You have got joint commissioner, additional commissioner. So this all goes into hierarchy. This is the hierarchy. And you have got assistant director, deputy, joint, additional, then DIT. From DIT, you got principal DIT, principal DGIT, and principal director general of income tax. So this is the hierarchy you have to remember. This section is very, very important from exam as well as from the practical procedural point of view and in your practice. The wide powers have been given to CBDT under section 119. By invoking 119, CBDT can issue any orders, instructions, or directions to its subordinates, which is basically the tax authorities that we saw, for the proper administration of the act. And it is obligatory. So there is no option. It is an obligation on the part of authority who are employed in the execution of the act to observe and follow the order, instruction, and direction of the CBDT. Now, this is always subject to one exception, and that exception is under no circumstance CBDT is empowered to give any direction so as to require any officer to make a particular assessment or to dispose a particular case in a particular manner. Now, this is basically to contain an abuse of power by an authority, that when the income tax officer is carrying out an assessment, CBDT cannot interfere so as to require that officer to do the assessment in a particular fashion or in a particular manner. And the same is the case with the appellate forum, that CBDT cannot give a direction to the Joint Commissioner Appeal or the Commissioner Appeal in exercise of the appellate function. Now, this point 4 again is also carrying a great importance in practice as well as important from an examination point of view. The Central Board of Direct Taxes has also been empowered for the purpose of effective management of the work of assessment and collection of revenue. They may issue any general or special order from time to time in respect of any class of income or any class of cases, setting forth directions or instruction not being prejudicial to the assessee. So this means CBDT has been empowered to issue any general order or any special order. Now, CBDT may also relax the provisions. CBDT may also relax the provisions of Section 139. Now, we have seen that in Section 139, the due date of filing the return is provided for various assessee. And in 143, 144, 147, the provisions govern the assessment. 154. Now, all these sections contain the limitation dates also. So, CBDT may relax the requirement of provisions, any of these provisions, so far as it benefits the assessee in a particular case, whether it is particular or whether it is general. So, this is a wide power given to the CBDT. CBDT is also empowered to authorize any authority by a general order or a special order to admit any application or claim for any exemption, deduction, refund, or, now this is very, very important and useful to remember for all practical purpose, any other relief under the Act. Now, this any other relief is not defined anywhere. So, if I am an assessee, I want to claim a particular relief which I could not claim for whatever reason, I can always approach this CBDT through the commissioner and ask them to give me that relief. What kind of relief I can ask? I have forgot to file the return for a particular year for so and so reason. Please allow me to file it now. Yes, I can make an application. I forgot to claim any exemption. I forgot to claim any deduction. I forgot to claim the refund properly. Whatsoever may be the matter, I can always file an application before CBDT, and to avoid a genuine hardship, the CBDT may pass an order. It may be a specific order, it may be particular to assessee, or it may be to the class of assessee or a class of cases. So in all these situations, CBDT can interfere and it can allow the application of the assessee. So this is very, very important. Now, in pursuant to that, in October 24, the circular was issued by CBDT to deal with the application for condemnation of delay in filing of return, claiming refund and returns for carry forward losses. So these guidelines provide the monetary threshold and the jurisdiction where the application can be filed. Where the claim is of amount of 1 crore for any one assessment year, if it is up to 1 crore, reach out to the principal CIT. If it is above 1 crore but up to 3 crore, then reach out to the CCIT. And where the claim is above 3 crore for any one assessment year, then you have to reach out to Principal Chief Commissioner of Income Tax. So this monetary threshold, whether it is the refund amount or a claim amount, whatever it may be, you have got a designation. If you file your return of income, then you are supposed to verify it by either sending the physical copy to CPC or by appending your digital signature or Aadhaar verification or net banking, whatever it may be, that the return has been filed under your acceptance. Now, in that case, if you fail to do it, under Section 139, we have seen the defective return. The system will treat your return as a defective and it will not be allowed to be processed as if it is not filed. Now, if there is a delay in verifying the return, you can file an application to the CBDT so that the condonation may be granted and the return may be processed by CPC under section 1192B. That application has to be filed under 1192B. The return will be processed under 143.1. The period for which application can be made. No condonation application for claim of refund or loss shall be entertained beyond 5 years from the end of the assessment year for which such application is made. And a condonation application shall be disposed of within 6 months from the end of the month in which application is received by the authority. For the application filed before October, the time limit up to which application can be made is 6 years from the end of the assessment year. So this is about updated return. This is about refund consequent to any court order. Now, this is also important to discuss. Let's just have a look at it and see if we have got any doubt. Right? So the white powers have been given. Taxpayers Charter, section 119, capital A. It has been codified now. Earlier it was like just, a kind of a public announcement about the Taxpayers Charter. But now it has been incorporated as a part of law. And what it says that the tax department is committed, and it has been legislated to say that it is committed to provide fair, courteous, and reasonable treatment to the taxpayer, treat taxpayer as an honest. So this is just for your information purpose. Nothing much to discuss about it, but yeah, very, very useful when you do the practice. So you can use this section, collect the correct amount of tax. So if there is any lesser refund or excess tax paid, and even if the limitation period is over, it is the duty of the department to refund that amount if it has been collected then more than what is authorized to collect. So you can use this section to kind of, to your advantage. So likewise, there are certain expectations also that you have to be honest, you have to be informed, keep the records very accurate and clear, respond in time and pay in time. Jurisdiction, again, one of the most important provision so far as the practical implication of the law is concerned. Jurisdiction. No officer can simply issue you a notice without a jurisdiction. You're not supposed to kind of respond to an officer who is not having a jurisdiction. So it is likewise. So CBDT has been empowered to issue the guidelines and set the criteria for jurisdiction, and that can be on the basis of territorial area, like within the city of, let's say, Mumbai, or within the city of Ahmedabad, Bengaluru. The jurisdiction over the people residing in those jurisdiction or companies incorporated in those jurisdiction would lie with Mr. X, Mr. Y, or Mr. Z respectively. It could be in relation to a particular class of person. Like, for example, for listed companies, there would be a different jurisdiction. For private, there would be different. For charitable trust, we all know it is the CIT exemption. For ITO or the officers have, kind of a different sort of a field or the set of people who are there to administer the law. Based on the income or class of income, so that is charitable trust, based on cases or class of cases. So they can have those jurisdiction-based, the classification-based jurisdiction. So this is just an informative provision. So you can always challenge, assessee can always challenge if the proceedings are being carried out by an AO who is not authorized to carry out the proceedings. So these are the parameters which are to be kept in mind. Section 124, again, a lot of practical implications. So AO has a jurisdiction in respect of any person carrying on business within that area which is allotted to him, or any person who is carrying out business or profession in more than one place if his principal place of business is in that area, and in respect of any other person residing within his area. So these are the ways in which jurisdiction is assigned. Let us now discuss the transfer of case. Who is authorized to empower the transfer of case? Let's say the assessment is being carried out in your case by an assessing officer in your area. For whatever reason, can that jurisdiction be transferred, jurisdiction to assess? Now, a little while ago, we discussed that CBDT cannot interfere in the way in which the assessment can be carried out, right? CBDT can issue the order, direction, circular, notification for proper administration of the law. It can, the binding, the obligation, it is obligatory for the assessing officer to follow the CBDT circular. But then we saw that the section also says that it cannot dictate the officer about the manner in which the assessment can be carried out or any kind of interference. Now, is transfer of case from one AO to another AO, is it an interference? To some extent, yes. But let us see how section 127 specifically deals with the cases of transfer. The power to transfer a case from one AO to another subordinate AO or officers is vested with the Principal Director General or Director General or Principal CCIT or CIT. However, this power can be exercised only after giving assessee a reasonable opportunity and after recording a reason for doing so. So, first thing, the power has been vested with the director or with the CIT, but this power can be exercised only after giving the assessee an opportunity of being heard. And the transfer of case is from one AO to another subordinate AO or officer is vested with the principal. So it is about one AO to another subordinate AO. Mutual agreement between higher authority to transfer. So first there has to be a consensus in-house before they can effect the transfer. There may be a situation where AO from whom the case is transferred and AO to whom the case is transferred, they do not fall within the control of same superior authority, CIT or DGIT. Now in that case, the superior authority concerned from whose jurisdiction the case is transferred, first they will pass an order if such concerned authority mutually agree for such transfer. If they are not in agreement about the transfer, then CBDT or any such authority authorized by the board will pass an order. Now this will be a case only when there is a disagreement. Now in certain cases, there is no need to give an opportunity. If the case is transferred between AOs within the same city, locality or a place, then it's not necessary to give the assessee an opportunity, provided it is within the same city. And the transfer of case may be made at any stage, whether where the assessment proceedings have just begun, or we are in the middle, or we are about to conclude the assessment proceeding and there's a show cause stage, any stage of proceeding the case. And it is not necessary to reissue any notice which is already issued. So it will be treated as a continuance of the proceeding. The moment there's a transfer of case from one officer to another officer, it does not mean there's a fresh start which has to happen. No, the proceeding will continue as it is, even if the officer is changed. Now, we are talking about transfer of case. Let's understand what is case first of all. Now, case in relation to any person whose name is specified in any order or direction issued thereunder means all proceedings under the Act in respect of any year which may be pending on the date of such order, direction, or which may have been completed on or before such date. And it also includes all proceeding under the Act which may be commenced after the date of such order in respect of any year. So it is proceedings. It can be any proceeding before the date of transfer or any proceedings after the date of transfer. Change of income tax authority. Now, the stage from which the succeeding authority would continue. In case where the authority succeeds another authority, that is, there is a transfer of jurisdiction, who ceases to exercise jurisdiction, then succeeding authority will continue the proceeding from the same stage at which the earlier officer left it. But he will have to give an opportunity to rehear. That means the assessee concerned, he will demand that before the continuance of proceeding, the previous proceedings be reopened or be reheard before passing of any order against it. So they are saying that, let's say a situation where assessing officer carries out the assessment throughout the year and 31st March is the last day to pass an order. In the month of March, officer has framed his mind and he has heard the assessee extensively, show cause notice is issued, hearing is completed, everything is done and he is just about to pass an order. And in that moment, there is a change of hand. There is a different officer who is coming into place. Now, in this case, whether it is obligatory on the part of the new officer to give again opportunity to rehear, the section says yes, he has to give an opportunity to be reheard. So even if you are already heard by the previous officer, the another officer, fresh one, will always give you an opportunity to be reheard. But yet, please bear in mind that the continuation of proceeding will be like in the same manner as if nothing has changed. So he'll continue from the same stage where the previous officer has left, subject to the condition that he is bound to give you a fresh opportunity. So this is about faceless, so we are not getting into it. Now, we'll also now discuss, I think, section 138, which is on yes. Disclosure of information respecting assessees. Under 138(1)(a), CBDT or any income tax authority is specified by a general or special audit. They may furnish or cause to be furnished any information received or obtained by the authority in the performance of its functions under the Act, which may be necessary for the purpose of enabling an officer, authority, or body performing any function under any law relating to imposition of tax or under any law as the central government may notify. Now, the focus is on giving the information. Generally, the tax authority always receives the information. Now, this section requires the authority to disclose the information to the taxpayer or a public at large. But then this is subject to certain conditions. Under 138(a)(1)(b), if a person makes an application as per Rule 113 of the Income Tax Rule to the CIT or Principal CIT, as the case may be, for obtaining any information relating to any assessee which is received or obtained by the Income Tax Authority in a performance of its function, then if, this is very important, if the CIT is satisfied that it is in public interest to do so, then he may allow that information to be shared with an officer. So, for example, if I file an application before CIT or a CIT to give me the income tax return copy of Mr. X, who is my neighbor, can I do so? I can do so. I can file an application, but I will have to justify before the CIT that asking that information involves larger public interest. It is in public interest I'm asking, not for my personal reason. So this is the sum and substance of section 138. Now, under the RTI Act also, just for general knowledge purpose, under the Right to Information Act also, the citizen of India can file an application not only with the Income Tax Department, with any government authority which is defined under that law, any public authority. So that law also is there. But yes, the common bit, the common connect or a thread between 138 and that law is this, that you can ask an information about a personal information about someone else only when that involves a larger public interest, and that you need to highlight. So I think that's all for today's session. We have, I think, couple of things to discuss in relation to, search matters in our Chapter 15 assessment procedure that could not be completed due to time limitation. So in the next session, which is scheduled on 17th, if the time permits, we will definitely have some discussion around that session. And if you have any query or question, please feel free to ask relating to what we have discussed so far. Are there any questions, Ashok ji? Or we can... Any questions, students? Understood everything? Smriti, any question? All right. So Ashok ji, shall we conclude today's session? Okay, thank you. Good night.